Ladies and gentlemen, welcome back. This is For the Love of the Game, Acquire and Operate Micro SaaS. Kale with you here again. Unfortunately, my co-MC, Kay Lou, is not feeling great today. So I'm rolling dolo and excited though. Nonetheless, we've got issue 20 and we're going to be kicking off with, it's crazy, 20 issues, my goodness. And we've been at it just over a year now, so it's wild how time flies. But to kick us off with issue 20, we're going to be doing, per usual, a deal teardown, where today we're going to be looking, and here I'll pull up my screen real quick for the visually prone. Here we go. All right, excellent. So quick table of contents for the issue that follows here. So we've got a deal teardown, which we're going to be digging into today. This is a seafood supply chain SaaS doing 750K ARR. Very, very interesting deal. Later on next week, we're going to be leaning into an operating concept, which can be another kind of change of pace here. We're going to be looking at buyer and acquirer profiles in Micro SaaS. So I started this exercise as kind of an open exploration of, I guess conventional standards are you have strategics, you have financial sponsors, you have fundless sponsors, et cetera. And they usually play at 5 million, 10 million, and 50 million in ARR. Obviously, none of that is generally applicable in Micro SaaS, where everybody's playing below, call it 3 million ARR. So trying to understand the profiles and the segments, if you will, that exist within Micro SaaS as its own defined segment. So I'm excited to lean in there. Then we'll move into an OKR teardown, where we're going to be going through a product release playbook. This was essentially, we did our first substantive product release in early December. Super exciting. Obviously, the culmination of a lot of work and kind of foundational effort. But we're basically turning that OKR into a product release playbook, which I'm excited to share with you all. And then musings, per usual, are going to be a little bit TBD. So we'll see how the month proceeds and what's on my mind, and we'll let it rip. All right. So what do we got here? Oh, one quick thing. So for the readers out there, sincere ask here is to start to populate and play with these polls, because we're trying to gather much more information to fine tune the content that's relevant to you. So this issue has a poll based around the content that you find the most useful. So what do you dig? Is it the deal teardowns, operating concepts, OKR teardowns, or musings? And help us kind of course correct accordingly. All right, so diving in, firm profile here. The in a sentence, we've got a seafood supply chain SaaS doing 750K ARR, as I mentioned. In a sentence, it looks like a profitable SaaS with 750K in trailing 12-month revenue and 320K in trailing 12-month profit, which provides ERP, which stands for Enterprise Resource Planning, one of the OG kind of legacy, or I guess kind of core pillars of business enterprise B2B software. But this is a ERP-based software solution for the seafood industry, which in my view translates towards likely inventory, sales, traceability, back office, and dockside operations management, along with quality control and sensor integration. So that's a mouthful and obviously a pretty broad scope there, but hopefully it's enough to kind of give us a directional North Star to kick this off. The asking price, they won 1.8 million. And again, as we noted, 750K in trailing 12-month revenue. This yields a revenue multiple of 2.5x. So in our category, I would say average asking multiple is about 3x. We'll go into comparables as we move into the teardown. Trailing 12-month profit, already noted, 375K. Running a pretty lean team here with 8 FTEs. Product stack is open ERP, which is vague, I guess, to say the least. And I think it creates both some excitement around, interoperability, and perhaps it's an open source ERP, but also some concerns that there might be some platform risk. Like maybe this is built upon one of the OG ERPs like Oracle or SAP, kind of the godfathers of enterprise SaaS. Annual growth rates looking juicy at 30%. And the firm was founded in 2018. So how did it do on the SV scorecard? Landed at 2.4 out of 4, which is okay. Obviously, we're shooting for 3 or above. But I guess we'll kind of lean into how that kind of score culminated. All right, so the industry outlook. So I think probably the theme, or what will emerge as the theme of this deal teardown, is the importance of what I guess I call like the Goldilocks just right niche. Niches that are big enough to be interesting, where you can acquire a user base that's significant, and by significant I mean yields kind of interesting and sustainable revenues. So we want to get into the 500K to 1.5 million, and we want to be extracting at least a 30 or 40% net income stream from that asset, but also small enough that the horizontal players, that the tech titans have chosen to pretty much neglect that specific niche. So it's a thin line here. And so I think as a disclosure or a disclaimer to kick us off, seafood, it's very well defined, but it is about as global as it gets, and it is truly, truly massive. So I guess right out of the gate, your spider sense should be tingling a little bit. It's like, oh, yeah, seafood, that's big, that's global. That's probably too big a niche for us to play as micro SaaS players. And I think it's important that we hone our instincts and kind of are able to make quick interpretations at face value just from a headline. So when you see seafood, it should be like, hey, probably too big for our britches, but worth a look nonetheless. With that said, let's move into the industry outlook. So in terms of market size and growth, so valued at 310 billion in 2021, and it's projected to grow. They estimated at 333 billion in 22 to 605 billion by 2029. So that's an 8.92% CAGR over that period. But it's I guess essentially it's going to double in the next 6 years. So pretty significant growth, and there's a lot of tailwinds here. I think society is increasingly health conscious, and especially as it relates to animal protein. So there's a lot of advice to move away from beef and poultry-based animal proteins towards fish. I would say a pescatarian diet is increasingly common. And so I think that's probably what's underpinning a lot of this. So now let's move into trends and drivers. So sustainable agriculture and fishing technology. So obviously sustainability is the top of everybody's mind, and stakeholders, namely investors and consumers, are holding producers accountable to sustainable practices. And obviously, as a function of that, systems and software help, I guess, implement sustainability processes, but just as important, their kind of documentation is embedded there. So you can prove that you're actually executing sustainable practices. So very critical in terms of an industry driver. Climate change adaptation. So I guess climate change is an increasingly large question mark. There's rising ocean temperatures, catastrophic events, et cetera. So as a function of that, if you're, I guess, managing a seafood production or processing operation, you need real-time analytics into what the hell's going on. So you can, I guess, react in real time. And then just as important, you want to be able to look into the future and kind of forecast scenarios or take advantage of predictive analytics. So that's another driver for technology adoption in the category. Traceability and transparency. We've touched on this a little bit, but this is, essentially consumer preferences. So farm to table, or just kind of understanding the supply chain for the food that you consume, is a huge macro trend. And that's obviously manifesting here in seafood. And then lastly, growth in online sales, AKA direct to consumer, D2C. I guess, and there's some theories that COVID pulled this forward, as it pulled forward a lot of like digital adoption and digital transactions, but there's definitely growth in folks ordering seafood direct from seafood farms or things like that. So that's another big one. Future outlook, short and sweet here, but headline is technology integration. So obviously there's a lot of systems at play. These systems need to play nice with each other, especially as you move up market. And then expansion in services. So I think I was unable to find some clean data on, and this is obviously always very much the case and difficult, but kind of understanding, okay, what's like the average tech stack at a seafood processor or producer. And then I guess the more point solutions you see, the more likely it is that there's a platform play coming that's going to pull together some of these point solutions into a cohesive platform, as we've spoken about countless times in prior cuts. So there you go. Industry's slapping, tech adoption. There's a ton of tailwinds, a ton of industry drivers that are moving it in that direction. All good things here, I would say. All right, so now let's move into an analysis of the firm. So we look at strengths, risk factors, and quick wins and opportunities. So out of the gate, there's pretty significant profitability. And it depends, kind of what your buyer profile is as a micro SaaS fund operator or acquirer, but 750K is a healthy revenue volume. And that provides work wiggle room, I guess, that room to play, room to invest, room to hire specialized talent, et cetera. And right now they have a 50% profit. So, and it's kind of interesting how you can interpret this, right? It's like, and as we always say, a lot of times weaknesses in a firm profile represent transformation opportunities. So you have to keep your mind open, and you have to consider that when you think about the cumulative score here. But right now they're running with a 50% profit margin. So that's an outstanding base. And I think one really or starting point, right? That's a great point of departure where you're inheriting a business that's, got 750K in revenue. You've got, call it 350K in free profits or free cash flow, net margin, that you can reinvest in growth. You can reinvest in the product. You can top level talent. There's a lot of stuff that you can do there. But one thing that's also very important is that the deal can afford itself, as is often said by kind of the search entrepreneur world or the buy then build world. Essentially meaning that there's cash flow to service the debt. So in this case, you would probably take, $1.8 million deal. We'd probably raise $1 million or so in debt. And I don't know what that'd be. That'd be like a $10,000 loan payment or debt service on a monthly basis. So you're comfortably paying the debt service there. There's no concerns around debt service coverage ratio. This is a business that is a good candidate for leveraged buyout. Okay, moving on to growth rate. It's so funny. I think we're conditioned by the venture world where it's like, 300% year over year growth. But 3% year over year growth is considered top quartile in SaaS for comparable firms doing 750K ARR. So it's growing. And I think what's most important is this consideration of momentum. The business, and I think inheriting momentum is a beautiful thing. And that's very often not the case in micro SaaS. Like you're kind of inheriting something that has flat growth, or the product is a little bit old, right? It's bootstrapped. It's kind of held together with bubblegum and duct tape. And so there's effort to build momentum. And once momentum's on your side, it's a beautiful thing, right? Snowballs roll downhill. But in this case, it's running, it's cruising. So now you can start to think about, accretive activities right out of the gate that'll expand that growth to something that's very, very interesting. And then team and technology. So 8 FTEs, again, that's a pretty damn lean operating model. We would probably be able to get the FTE count down and pivot to more contractual, freelancer-based global work and labor. But 8's nothing. They're doing a good job running a lean outfit, is bottom line. And then they're using an open ERP technology, right? Which I guess implies that they're kind of building on a base that's already fundamentally there, right? So they're not wasting their time with database architecture, with relational database kind of querying, stuff like that. Like you have a very strong foundation to the house, which allows you to move fast. On the other side, you could be beholden to a platform like an ERP or an Oracle, which introduce platform risk, such that if their cost structure changes, that can blow up your margins. If they take a huge shift in their roadmap, it can have real, I guess, negative implications on your product, on the functionality. So that's a two-edged sword for sure, or two sides of a coin. But nonetheless, I think we interpret it as a strength out of the gate. All right, now moving on to risk factors. So now we start to see, I guess, the risks that manifest here that we can assume are a function of the size of the niche. And I don't even know if we can call it a niche. Let's just call it a category. But, we're talking about a multi-billion-dollar market that is seafood. So then obviously the seafood software market is going to be a derivative of that. But in a context like this, you've got competitive pressure from basically every profile. You've got the OG tech titans, and I mean tech titans like SAP, Oracle, like blue chip Fortune 500 firms, and they're building horizontal applications that are for any kind of assembly line input output related thing where they need to understand inventory, they need to understand throughput, they need to understand efficiency in real time. But those players are in the market and they've been in the market for years, and they probably own most of the enterprise market. So you got those players, which you hate to compete with on any day. And then you also have groups that are accommodating the category in a little bit of a broader regard. So they're going after animal protein processing more broadly, as noted. So think instead of just seafood, they're doing beef, poultry, you name it. So those players are obviously well-funded and very well established. And so you have pressure from groups that are, I guess, have already competed market share away from the horizontal players by being a little bit more nuanced to the niches that they serve. And then below that, we have some direct competitors that are just going hard as they can at pure play seafood. So again, you've got big, intimidating animals of all breeds, pun intended, sitting around the table. And that's got to be kind of the first thing that crosses your mind from a risk perspective. So now moving on to the platform risk or the open ERP as a core technology. So I think anytime the tech stack is kind of stated this vaguely, you probably want a little bit of a yellow flag. OpenERP doesn't really tell you much. And as I noted, let me just move this up here. Our starting assumption is that I guess the risk is that it's just a simple UI or like some kind of configuration of pages or layouts that is off the shelf that sits on top of SAP, NetSuite, or Oracle. And there's really no novel functionality. There's no proprietary application. They're basically taking a meal where all the value is created and just kind of remixing the ingredients a little bit. And this is, I guess, a metaphor that's very relevant right now. But a lot of what we saw with the AI, the generative AI applications that raised all this money was like, oh shit, like this is just a wrapper of ChatGPT. So it's just a UI that sits on ChatGPT, but ultimately ChatGPT's underlying model and the data set is what's creating all the value. And it's very easy to rip off a wrapper. So we saw those valuations literally just poof into dust once investors realized that. And it's a pity that they weren't able to realize that on the front end because a lot of people just got totally wiped out in their positions. But on the other side of the coin, if the company has built unique applications or modules that are an extension of a platform or are a function of an open source ERP, and there are lots of open source ERPs, there are open source CRMs, things like that, then it starts to get really interesting. And I would say the risk profile is much lower. So now we've got flexibility working for us. We've got predictability in terms of what's happening on the roadmap and independence in our movements. So that's probably all that needs to be said there. Moving on. So, and again, there's trade-offs always in every deal, but I think there's a lot of acute ones in this specific deal. But lastly, we have buyer tendencies / tech maturity. And this is like kind of a fundamental concept or mental model that we've borrowed from Crossing the Chasm. If you haven't read it, I would consider it required reading for our world. But I guess the holy grail is to catch a market when the innovators have, I guess, brought in the early majority and there's some level of adoption and you're just about to cross the chasm into more broad adoption, bringing on the laggards. And obviously the buying behaviors and the profiles of those cohorts are totally, totally different. The thing that's tough is when you come into a market very early, and we see this a lot with this digital transformation. So it's like, hey, this is an analog industry. They're using manual spreadsheets. They're using, pen and paper. I shit you not. You see that still in a ton of categories. So that on the good side, oh my goodness, we can digitize and bring so much visibility and efficiency and transparency into this work. On the other side, humans don't like change. And that's pretty radical change. So I guess the risk here, and we'll talk about how this player would definitely want to focus on SMB mid-market because we can assume the larger the accounts, the more likely that you're competing or that the accounts have already been acquired by the more broad animal protein players or the horizontal players. So I would say probably the only chance to scrape away some market share and make this an interesting business is to go hard at SMB and mid-market because the other players find those accounts to be just too little to be worth their time. With that said, the smaller businesses, I guess, tend to be behind the standard or consensus when it comes to tech maturity and the, I guess, adoption curve in that regard. So that's a hardcore trade-off. We're intentionally going after a market because we know it's less competitive, but we also know that we have less things working for us, namely the likelihood that they'll be excited or, I guess, quick to move or even motivated to adopt new technology. So some trade-offs there. Now on to quick wins and opportunities. So we're literally going to fly right into kind of the similar thought process. So I think out of the structurally from an opportunity perspective, and I don't really see many quick wins here. So these are more, I guess, mid to long-term opportunities that would take some building, some capabilities building to get you there. So you'd have to be patient and kind of eat your vegetables, so to speak, and get stuff in order. But the first thing is fixating on SMB and mid-market for the reasons that I just mentioned. So we know that or we can assume hypothetically, and we would validate this obviously, but SMB and mid-market is probably the best hunting ground for this firm. On the other side of the coin, if they're kind of early or if they haven't kind of achieved early adoption, then you need to target the innovators, and you're going to spend a lot of time educating the market more broadly. Why does it make sense to embrace software? What are the benefits? What are the hard ROIs that make it brain dead to adopt the tool or to make the investment? So it costs money to educate the market and it takes time. And I guess that's probably where we can leave it. Oh, one thing to note as well is I think the holy grail too, or I guess don't sleep on the impact that tech maturity has on buying behavior. So if you're thinking about shaping an ideal customer profile, you're very obviously starting with firmographics. These firms have this many employees, they generate this much revenue, they operate in these regions. Then maybe you layer in technographics, they use QuickBooks for accounting, yada, yada. And then maybe you layer into personas and you start to think about the roles that are involved in a decision-making process, what their, I guess, motivation is, what their pain points are, et cetera. And it's very kind of rarely considered, okay, like what's their proclivity or the likelihood that they adopt technology quickly. So definitely consider tech maturity. And then that calls into question, well, how the hell do you identify that quantifiably? So as a simple, and that's kind of the holy grail, because if you can understand where they are tech maturity wise, it basically informs the rest of your sales motion. But as a simple example, it's like, do these accounts have a polished website? Yes, no. And that's a little bit subjective. So I would encourage you to kind of define that on a spectrum and score it. But if they have a polished website, cool. Let's consider them innovators in this SMB mid-market category. Let's go hard after them for acquisition, because that's probably the lowest hanging fruit. Okay, zooming back, establish a sales function. Simple as that. Right now, this firm has 0 sales function. So, and that's exceptional if we go back to the 30% growth, because that means it's purely kind of a word of mouth, happy customer driven growth loop, which is the hardest thing to create. And it's a good vote for the efficacy or the utility of the product, and also for retention and other stuff. But got to get a sales function going. And I think this is probably an assumption in anything that's ERP related, because when you're selling an ERP, there's so much variance in the workflows. There's so much variance in the tooling that exists, in the data sources, which are a function of the tooling, that it's very rare you can have a PLG onboarding process or sales process. Put another way, you have to consult the account. Hey, this is what you have. These are the opportunities we see for improvement. If you move in our direction and buy this software, we can consolidate applications, we can streamline these workflows, we can give your leadership visibility into the future, et cetera. But, and I guess that also translates directly into implementation. Okay, cool. We're going to get you started. We need to, access to these systems. We need to export data. We need to clean it. We need to move data, et cetera. So you need a salesperson to consult and, I guess, make recommendations based on a suite. And then you need a human implementation team to get it off the ground and get time to, kind of time to value, time to activation, et cetera. So ERP oriented, you can probably assume it's SLG to the bone. There's obviously some novel opportunities to weave PLG in there, but that's required here. And I think that's an obvious growth lever, and that takes time, and it costs money, which we'll talk about how that kind of erodes what was exciting about, the profit margin, because basically all that profit margin is going to go towards sales compensation if you want to generate any growth. But enough on the established sales function. Let's move on to prioritize expansion revenue. So I think, and these are assumptions, but I got the impression that the SaaS is modular. So which means that they have a portfolio of products to sell. So a lot of times there's so much emphasis on new logos, generate new logos. And I think that's misguided. Expansion revenue is your best friend if you have a critical mass of users and you have more product in your portfolio to sell them. So order of operations here is pretty simple. You establish kind of a penetration score for each account based on the products they have and don't have. And then you ideally are able to identify like the highest probability product in your portfolio that they haven't bought. The coolest way to do this is programmatically, where it's like, hey, they bought this thing and they're using it, so we can capture signals that are unique to our point of view to kick off expansion sales process. So it's like, hey, we noticed that you were just doing this. That makes you a great candidate for this other product in our portfolio that'll accelerate that job to be done or that outcome. So that's kind of the holy grail. It's kind of called programmatic expansion, where you use product usage data to kick off prompts that then signal or trigger a sales process outreach of some capacity. The other thing that's worth noting is that you're building on a critical mass of rapport and trust. So expansion revenue often has much higher win rates and a much shorter sales cycle time. So all those things come together where it's like you have an edge on what to sell them and when. They trust you, they like you, and they're going to buy, more likely to buy, and they'll buy at a faster rate. That's basically just like a perfect storm of everything you want to grow revenue. So definitely prioritizing expansion revenue here would be priority number one once the sales function is built. But that would have, I guess, a huge impact on the structure and the nature of the sales function. Instead of going after new accounts, aka hunters, you would probably think about customer success people and hiring farmers. And then once you kind of have squeezed the expansion lemon, so to speak, then you'd move on to new logos and think about tooling and staffing up accordingly. Lastly is pricing and monetization. And this one's a little bit tongue in cheek, because it's like, I mean, all we know is that it's an annual license. So, but if we zoom back, right? I mean, supply chains are a function of inputs and outputs. Like there's a lot of volume having to be had here, or things that scale, and ideally, the more efficient the inputs yield the desired outputs, the more value that the software provides. So there's got to be a usage metric in there somewhere, I guess is what I would say. So you probably want to come in and look really closely at pricing and monetization. But if you see these things, right, I mean, it starts to become pretty interesting because you can establish a sales function, start with customer success, and get after expansion revenue hard as you can. All the while, you're doing some very rigorous analysis to inform a pricing and monetization refresh. You then introduce that before you go acquire new logos, and over time, you roll out and normalize the new pricing plan across your legacy users. I mean, that's interesting shit, to put it bluntly. I mean, I think you could probably expect 20, 30, 40% revenue growth just running those levers before you start to really get after new logos. So that's all kind of top line revenue improvement without like hardcore organic growth, I guess is what I would say. Because hardcore organic growth, aka new logos, is the hardest thing in the world. All right. On to market comps. So a lot of numbers here. Apologies for the listeners. I'll try to take it slow. And just as a reminder, we're looking at comparables as a function of ARR. So in this case, we're looking at 650K to 850K ARR micro SaaS firms. And we look at 4 dimensions: asking price, revenue multiple, trailing 12-month profit margin, and growth rate. And then we give it thumbs ups and thumbs downs. So this firm has an asking price of 1.8 million. Oh, I need to fix that. That says K. 1.8 million. Comparables are asking 4.8 million. So significantly lower asking price. That gets 3 thumbs up. On the revenue multiple front, this firm is asking 2.4x. Comparable firms are asking 4.8x. Again, 3 thumbs up. And I think it's important too that multiple has an exponential effect, right? Whereas asking price, it's like, all right, this one is 1.8 versus 2. When the multiple changes from 2 to 3, it multiplies. It's a multiple against revenue, right? So I guess by definition, it has an exponential effect, but a variance in multiple is a big deal. Moving on to trailing 12-month profit margin, this firm is doing 375K. Comparables are at 425K. So we give it 1 thumbs down. Lastly, growth rate, this firm's at 20%. Comparables were at 52%, which I was kind of surprised to see. Obviously, growth is, I guess, overstated in a lot of these cases, but is what it is. That lands us at 2 thumbs down. All right, let's wrap it up, folks. So into concluding thoughts. I mean, the bottom line, the revenues and the profit margin are good. They're solid. It's like, ooh, this is a nice kind of mid-market micro SaaS deal, if you will. And those are always the most limiting factors or constraints in our world. And I think one of the big knocks on micro SaaS is that without revenues, you can't hire top talent. So you're kind of doomed to fail. Obviously, you can be thoughtful about that and you can pivot the cost structure and the operating model as it relates to labor to more contract, part-time, globally distributed teams. But in this case, it's like, ooh, wow, 350K in net income per year. We could, invest 100K in product and 100K in acquisition and still have 150K to service debt and kind of keep a rainy day fund. So those things are working for it. Lastly, the asking price and the multiple are very reasonable. So all things like on the most macro, it's like, cool. All right, this looks good. Unfortunately, as we've kind of hammered to death at this point, it's just not niche enough. So, and I think this really kind of is a case in point for an edge to be had in our world where it's, kind of finding, as I noted, like those Goldilocks or those just right niches that are big enough to generate interesting revenues and income from an operator perspective, but small enough to be neglected by the players that scare you. And unfortunately, this one is way, way, way Papa Bear. This one's too big. So anyway, it's just not quite niche enough. Lastly, there's really zero product-led growth to be had here. You hate to base a point of view on what's been done to date. You don't want to restrict yourself there, but no one's been able to spin up a product-led growth loop for ERP-based domains. And it's just extraordinarily challenging. As I mentioned, you've got different stakeholders who have different workflows that use different technology, that harvest different data. And it's a puzzle that you have to put together for every deal. And that makes it just kind of a pure play sales-led growth thing, which is not really our jam. And I guess just to the case in point, right? I mean, I think back to that profit margin, it's like, all right, 350K. It's like, cool. We're going to hire 2 CS people. Okay, let's say average salary is for somebody competent, is like 85K, and we're going to pay him 20%, commission. That would be, very solid for them. But it's like, okay, that's, boom, 200K gone, right? So now you've got 150K to work with. At least 100 of that's going to go to debt service. And now you've got 50K kind of for a rainy day or to invest in products. So things start to get a lot tighter very quickly. So all things considered, doesn't fit our profile. But as I mentioned, I think I kind of find myself at this stage being challenged to think bigger and to think bolder about the niches that we go after, like just being more intentional about that Goldilocks kind of tipping point. And as we wrap with here, fortune favors the bold, damn it. So I think this might be a signal from the stars that we need to start being a little bit more bolder in our thinking. And my ask is that you all keep us accountable here. Yeah. All right. That was record time there. I'm about out of breath. So cool. Hopefully this was useful. I will see you all next week for the operating concept. Teardown. Much love, y'all. Happy holidays.